Our next video is devoted to tangible non-current assets. And just to remind you, we're still within the ICCA's FA2 paper maintaining the financial records. Now, we talked about assets over the past videos, and now one important thing to consider is the capital and revenue expenditure. It's a major accounting concept. Basically, a non-current asset is something we will use for more than 12 months. So anything that we will use for more than 12 months will be accounted for as debit, non-current assets, credit, cash, or payables. However, once we buy something like this, there will be certain expenses which we will incur that might increase the value of the asset or not. Now let's look at a simple example of a building. If one day we decide to build up a few more floors over what we have, that is an extension to the building which will be treated as an addition to the non-current assets. That will be the capital expenditure, very often called CapEx. Now, sometimes, on the other hand, we will incur expenses which are related to this building, but will not be treated as an extension to the value of a non-current asset. For example, if we decide to paint it, that's just maintenance. It does not increase the revenue generating capacity of that building. In other words, we will not make more money. It will not increase the capacity of the asset to bring us money because we painted it. So if we spend money in that way, that will be revenue expenditure, not related to earning more money. And as such, it will be posted as debit expenses, credit, cash, or payables. Alright, that's capital and revenue expenditure. Everything that increases the revenue generating capacity of the asset will be capitalized and therefore will be a capital expenditure. Anything that just maintains or restores the revenue generating capacity of an asset is a revenue expenditure, and it will be shown as an expense. When we buy non-current assets, the accounting for it is the following. We debit non-current assets and credit whatever, bank, payables, or cash. Now, probably one of the most important concepts for non-current assets is the depreciation. Depreciation, if you want the definition, is a systematic allocation of the cost of the non-current assets over its useful life. What it means in practice is when we buy a car for $100, and that car will run for 5 years. If you recall, that 100 we treat it as a non-current asset, right? So we put it in the statement of financial position $100. However, ultimately this asset wears out. If we bought it with a view of using it for 5 years, we thought, at the end of those 5 years, we'll probably need another one because we estimate the revenue generating capacity of this car for 5 years. So 100 divided by 5 should be expensed of that every year. So every year this value will be reduced by 20 and expenses will be recognized. So debit depreciation expense, credit, well, technically speaking, non-current asset, but in reality the accounting tradition is that you record this depreciation as a separate account, which is called allowance for depreciation. Now, just to be absolutely clear about that, we said it's going to be just 100 divided by 5. That's a simplification. In reality, it will be the cost minus estimated residual value, which means the amount for which we expect to sell the asset at the end of the useful life, divided by this useful life. So we made a tiny simplification here to make things clearer. Now, when we sell a non-current asset, there will be some entries involved as well. Every time we sell a non-current asset, the proceeds from sale, which is basically how much we got for it, will be compared against something that is called net book value. And net book value at any point in time is the original cost minus accumulated depreciation. So in the case of our car from previous example, the net book value after 1 year will be 80, 2 years, 60, 3 years, 40, and so on, until in year 5 it will reach nil. The profit when we sell a non-current asset will be calculated in the following way. We will have a non-current asset account. Let's stick to our example of 100 for a car. And let's say we sell after year 2 for $70. So after year 2 we have allowance for depreciation of 40. And now we sell it for 70. We will record all these transactions on something that's called disposal account. We sold for 70, and when we sold it, obviously we need to get rid of it from all the other accounts. So we get rid of the original cost, and we get rid of the accumulated depreciation. Now it turns out that there is a 10 of profit on this disposal that will go to income statement. Well, this profit was quite obvious. Proceeds were 70 versus the net book value of 60. That leads to a profit of 10.